Hey everybody, this is Jim at SP500chart.com. It's about 6:30 on April 6, 2014, and we're going to take a look at do things a little bit differently. We're going to look at, in addition to the S&P 500, we're going to take a look at some other indexes, maybe some things we haven't looked at in a while. Because of what we saw on Friday, I think there's been some requests that maybe we just branch out a little bit from the S&P, look at the Dow, look at the NASDAQ, maybe look at the Russell, or maybe even look at another Russell component index to try to get a feel for what may be going on. But before we do that, I need to remind you that the website and this video are for educational purposes only. Nothing stated at the side or in the video is intended to be used as investment advice. I can draw these lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I am not a licensed financial professional. I'm just a guy who draws lines on charts. So let's start this from a little bit different perspective. Starting off with a 3-year chart of the S&P. Here you go. There's our March 2009 bottom where it was the end of the world, remember? And everybody should just bail out, get it over with, and look at when there was blood in the streets, the time to buy, not the time to sell. What were a lot of people doing back then? They were selling. I hate to say it, but within just a couple of weeks, the S&P went from about 870 down to 666, a 25% loss in just a matter of weeks. Well, probably about 2 months, because this is a 3-day chart. Then we've been in this uptrend bull market ever since. We are in new territory. We are at 1865, and even though we had a rotten day, particularly with the NASDAQ, the S&P was down 1.25%. When you look at this chart, and then you look at that little tiny red candle right here. I mean, really, is it the end of this run? Certainly not based upon just that. However, let's zoom in just a little bit. Looking at this now on an hourly chart. And this is what I want to remind you of, okay? I know this looks like a bunch of chicken scratch, but I can't get rid of any of these trend lines because I like them all so much. But as we look at it now in this scale, I just want to remind you, for about half of the time in the month of March, and so far most of the time in the month of April, well, really, actually, I guess if I'm going to include March, I need to say this. For the past 5 weeks, the S&P has been in all-time record high territory, jumping around, moving up and down by about a 40-point range. We got over that. I thought we were in a legitimate breakout above 1884, but we gave that back up. That all got erased on Friday, as our rising channel that we had identified here, this green line right there, broke down, and you could see it was an ugly day. We had a high that was just 3 points shy of 1900, and then we end up with a low that is 34 points underneath that. So that's a pretty nasty swing in one day. And I'm not making light of that, but you can see that for the past few weeks we have been quite volatile. What I want to point out here just real simply is every time we have had one of those gaps up, the market has sold back and found gap support. There was a big gap up in early March. Boom! We sold back over about a week and a half period, and then we found some gap support a little bit underneath, but then we made another gap. We came up and then we came back, gap support. We gapped up again right there on the 28th of March, moved up, and now we're coming back. And if I was just guessing, I would say we are either going to find some support at this gap that took place actually not on the 20, what am I looking at, the 28th, but the next day on the 31st. Maybe we get some support there. But you know, guys, coming back to back test is not that big a deal. So what I would be looking for is the same thing we've been looking at the whole time. And I'm going to extend this little fuzzy area out here. Let's see if we get our bounce in this area if we see this sell-off continue down. We could also bounce at this teal trend line, but this is not a perfect trend line. It's it goes back to November of 2012. It's got a rich history, but you can see that it also has, on occasion, particularly back here in the early February, it has shown itself to be at times a bit porous. So if we were to break down through this 1840 area, then I would be looking again at either this kind of a mustard colored line right here, or roughly 1800 as support. And even if either of these things happen, the way I'm looking at this chart, before we can say that things are really in dangerous territory, I think anything of that nature is going to be guesswork until this blue line breaks right here. So this is the one, if you're looking at something and you're saying where is the trend line that if it breaks, I should really be on alert and be vigilant that we may be making a significant top. I would say this blue line right here. Unfortunately, this blue line is significantly underneath that 1900 level. It's around 1740. So we're looking at something that's roughly 7 to 8% off the market highs. You know, it is what it is. But for right now, in the shorter term, let's just see if the same thing holds true. Because like I said, we came up, then we came down, got up out of this little blue channel, back tested it, came back, even challenged the lows that were back here, then rallied again. Now we're just showing some more of this volatility. This could be a turn, it could be a top, but until it shows itself by breaking down through some significant trend lines, I don't think it's a bad idea to be aware of where those lines are, but at this point in time, I'm not overly concerned or overly worried. I was hoping that we would get a bounce at about 1874 because that line had been technically significant, but again, sadly, no, we didn't. So if we continue to sell off, let's see if we bounce at either this teal colored line that would be around 1855, 1856 on Monday, or the 18 to 40, 1850 range that has been support on 1, 2, 3 occasions already. Now quickly, let's take a look at some other indexes. We're going to look at these all on a daily chart because I think that this is probably the best way to do it. You can see the NASDAQ really is as ugly as it was down almost 3%, down 110 points. You still can see that we are in still very, what's the word I'm looking for? We're not even making a new low. Let's put it that way. We have a series of significant lows along the way. Maybe we're just in the process of making another. We have a longer-term support at this blue line. We've got short-term support at this gray line, I think, and we have intermediate support at this red line right here, which we have not even come down to yet. So I think there are a number of areas where we could see the NASDAQ sell off to even more without saying it's all over. Let's trudge on. Let's look at the Dow Industrials. Here's your Dow Industrials again. You know, we just came up. You might say double top. Well, maybe. You also could have said triple top back here, and it wasn't. So again, here is longer term support. This blue line, which doesn't quite fit as nicely as our S&P line, but you can see that has been a significant line. That's probably the one for the Dow. Let me adjust it again just a little bit more. That, you know, if that breaks, then the Dow, if we get down under 16,000 and crack this line right here, maybe for the Dow Industrials, maybe that's a heads up. Maybe this is front running the S&P just a little bit. But still, even with the ugly day we had last Friday, nothing's really broken. Not yet. Let's look at the Dow Transportation Average. Here's your Dow Transportation Average. It doesn't look bad at all. And I'll remind you, a lot of people look to the Dow Transportation Average as the leader of the pack. And you can see that really, if we move in just a little bit more closely, here is all-time high territory at 7,600. And here we are 29 points underneath that. As a matter of fact, you could even draw a little trend line right here and say, at least for the Dow Transportation Average, it just looks like a run-of-the-mill pullback. Now, that's not what we're seeing in the other averages, but the case could be made here that, nothing's particularly busted up at all. So, again, we've got lines that we can look at over a long period of time. I'll go ahead and throw this one up right here. Again, it's not quite as nice a picture. I think we'll do it like this. And you can see that the Dow Transportation Average is significantly higher than where we would need to be before you could say with any technical analysis reasoning that this looks bad now. It doesn't look bad now. It looks weak, but bad as in busted long-term trend, I'm not seeing it. Finally, I think we've looked at the NASDAQ, we've looked at the Dow, we've looked at the transportation industrials. I want to show you one more chart real quick. Okay, now we're looking at the Riffin, which is the Russell 1000 Financial Services Index. This is a chart that I was following really closely back in 2009. As a matter of fact, it was this chart that originally led me to believe that we were in a significant bull trend back in the summer of 2009, because we had a very clearly defined inverted head and shoulders pattern in this index that had a target, a crazy target of over 1,300. And I was just thinking back in the summer of 2009, I was on the Yahoo message board for the 3X Financial Services Fund ETF, FAS, F-A-S, and I was saying, guys, this thing's going to run. We're going to get well over 1,000. at least, and the shorts on that board were just giving me what for, saying you're a lunatic, you're absolutely crazy. But I'll say this, for those of you who enjoy the website and these videos, it was those conversations back in the summer of 2001, the summer of 2009, that was pretty much why I started doing what I do for you guys today. So anyway, you can see here that if we look at this chart in a long term and we look at what's taken place over the past number of weeks, really, as far as the financial services go, this looks to be kind of almost a run-of-the-mill consolidation. So again, just another piece of evidence that says no long-term trend has broken. I think we're seeing a pullback, sure. I think we may see more of a pullback, sure. But until the long-term trend lines start to fall, I'm not ready to throw in the towel. So guys, instead of doing the weekly review, I just wanted to branch out a little bit and take a look at some of these other charts. And I hope that this may serve to give us a little bit broader perspective on things. So as far as the S&P goes this week, I'm looking at basically we're just erasing that breakout over 1884, and we're saying we're back in that 1840 to 1850 to 1884 range. Remember, that lower range is 1840 to 1850. It's fuzzy, so it looks like we may be headed there to test that again for support. And if we get a good bounce, then 1884, 1874 to more discrete levels where we have seen resistance. So that's not a range. 1874, there's resistance. 1884, there's resistance. When we come down, the support is a little bit fuzzy. 1840, 1850. So guys, that's it. That's the video. I probably talked way too long. Appreciate you taking time out of your day to watch this. Take care. Oh, I got one more thing I need to show you. Sorry about that. I almost forgot. I got a phone call this week from a subscriber who was concerned about this upper resistance line right here, and he made the comment that on his chart it looked like we made a touch on this line, and as I have that placed, we really haven't done that yet. But I want to remind you that this line is going to be tough to really see going forward, because it is defined by 2 points that were more than 3 years ago. So in other words, if there is any discrepancy, or if there was any overshoot or undershoot in any of these data points back from 2010 and 2011, whatever error may exist between this but in this year span, it gets multiplied as we extend out. And I've used the analogy before of doing target shooting with a short-barreled pistol. The shorter the barrel, the less distance between the front sight and the rear sight. And that means getting a good, solid aim is more difficult. So as we look out and we extend this line, it starts to become less and less reliable, not because it is no longer active, but because we don't know exactly where it should be. So, as an example, if I back this up and I started on our beginning point right there, and then I say, well, maybe we got a little bit of overshoot on this first one, well, then we did touch it. But if I look at it and I say, no, let's actually make it to where we haven't quite, to where it just touched back here, well, now we haven't touched it. So this line, depending on where you have it drawn, may or may not have been touched. But we still have, and I know I'm talking way too long, I still think there it is back kind of in its original position. I'm still thinking we've got this pattern back here that points to the mid-1950s. I would really like to see that happen. If it does, that's great. If it doesn't, so be it. So guys, that's really the end now. So I'll say goodbye. Thank you for watching. Take care.